Microsoft says it's investing more than $7.5 billion in Canadian AI infrastructure over the next 2 years. That new capacity is expected to come online in the second half of next year. Let's get more from Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management. Benjamin, thanks very much for joining us. Put this in context. Does this look like a bold move by Microsoft?
So we think it makes a lot of sense. We've been saying for a little while that it makes a lot of sense for more AI investment and AI infrastructure to be built in Canada. And we have the power generation. We have, of course, the preferable climate, keeps it nice and cold without having to pay anything. We think this is a very reasonable, by Microsoft. Hopefully there's more where this came from and it can move the needle for the Canadian economy as well. But we think this is a win-win for both sides.
It's interesting. The Microsoft PR department have been busy. So they're saying if you include investments since 2023, this will bring them up to $19 billion Canadian, or about $14 billion US. However, at the same time, they're pledging almost $18 billion in India for AI cloud. So they're trying to, I guess, reassure governments around the world, hey, we're going to be spending on AI within your borders.
Yep. I mean, if there's if this is just the beginning of the tip of the iceberg, so to speak, there's plenty more billions where that came from. So you might as well make as many governments happy as you can.
Yeah, and we hear this talk of AI sovereignty. Countries don't want to be left out, but we just don't have the capital in this country to emulate what the US is spending on data centers.
Yeah, I mean, this is, I think, a lot of the investment is going to come from companies, particularly based in the States, like your Microsofts and hopefully your Amazons and other providers. This is a good start. Hopefully, there's more where it came from.
You're in the camp that says the Bank of Canada stands pat tomorrow with no cut in interest rates.
That's right. I don't think we have a contrarian view. This seems to be very much the consensus expectation. The economic news, I think, has been better than most people anticipated. Obviously, we've had a couple of quarters of pretty strong job growth and positive GDP surprise in Q3, which is very nice. I don't think there's a lot of downward pressure, at least for this rate announcement, but I think the expectation remains, at least for us, there will certainly be pressure on rates in 2026. Will they go down? How many hikes and how much? I don't think anybody can really hazard a guess on that, but we expect no change tomorrow.
You like the look of Netflix. Of course, they may have a tough job buying Warner Brothers because of monopoly concerns in streaming, but generally you think it's a great business to own?
Exactly. So on the whole, Netflix we still think is the best-in-class media business. It has the strongest growth. It has the best profitability. It has a huge lead in technology, a huge lead in scale. They have a creative management team, always looking for not just adding new content, but adding more content types like video games and other things to the platform. Mm-hmm. We think this could be a tremendous opportunity for Netflix. Obviously, yes, there's the regulatory issues to worry about to see if it goes through. But we think that if it does go through, Netflix has really all of the tools to fix HBO Max's problems, more or less. And they have HBO Max has the best content. Now, they're the gold standard for content, but because of their lack of scale, they've really found it difficult to make money. A lot of their subscribers, of course, get it through just distribution bundles. So Warner Brothers doesn't collect the full subscription fee on that. And we think that Netflix, by utilizing their advantages again in technology and scale and their free cash flow to invest in the business, can really turn things around for them. They can even, of course, they're going to be almost certainly required to keep them separate, at least for now. So your James Camerons, your Christopher Nolans can keep their theatrical window. And we think, again, this is a tremendous opportunity for the business. And we think Netflix is almost certain to say, look, we are going to agree to any regulatory demands of us because it's such a great opportunity.
Still, there's got to be concerns about movie windows because Netflix has such a strong incentive to get them on its platform and have movies running a very short time in the theaters.
Yeah, and of course there are going to be a lot of different details that need to be worked out. But we think that if part of the issue is theatrical windows and streaming for going to streaming after a certain number of weeks or months, we think that Netflix is going to be very willing to make any concessions needed because it's such a great opportunity for them.
Adobe is such a fascinating story. They've had a miserable year. But of course, they have a lock on the professional graphics and they're big in video editing. So you think, wow, look down almost 40% in the past 12 months. You think investors are missing value here?
Yes, it's been a very rough ride for the stock, no doubt about it. They're reporting earnings this week. This is really, for us, not a hugely complicated thesis. We think the company is dramatically undervalued. This is a company that is growing at double digits, capital light, recurring revenue business, great margins, and they're trading well below market multiple. You really cannot find opportunities to buy a company that's consistently growing at double digits, that has been for years, and trades at a valuation as cheap as Adobe. Now, of course, there's a reason. The narrative is that this company could potentially be in trouble from AI image generation and various other kinds of AI disruption. Management has been very clear and very plain. They have not seen any of this yet. Could it change? Of course, going forward, yes. But we think it's at least as likely that Adobe is able to leverage AI in their own suite of products in Photoshop and Illustrator as being disrupted by some kind of outside force. So our view is this is a dramatically undervalued company. We think market sentiment will turn as they hopefully continue what we have seen to be strong earnings, and we think there's a lot of upside for the company.
Benjamin, great to talk to you, and thanks very much.
Thanks for having me.
Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management.